that we've seen recently, how to still scalp around what has become a low vol environment, but then also look at some of the futures offered in the small exchange that could be good investment tools and good hedging tools against a long stock portfolio. A lot of different stuff to kind of pivot to here, because when markets slow down, Pete, you don't just stop trading.
No, it's a great. Are you trading the same amount? Are you trading the same size? Do you have as many strategies on? Not necessarily, but it's so important, and we always talk about this, to stay engaged. It is a key part of not over trading, not trading to trade, but staying engaged. And how do our strategies modify when markets do slow down? When we don't get the volatility that we want, the back and forth, the number of unique ticks. It's an important piece of, it's another set of strategies. And that's why you have to look at, we don't put strategies and, so to speak, force the market to do, what, I want to really be aggressive, so I need the market to do this. We basically take what the market gives us and then deploy the strategies we find most effective.
Yeah, and this is what I talked about this week for subscribers, Pete, was the fact that gold and silver and platinum all packaged into the nice SPRE futures, the small precious metals futures, movement across those metals has gotten much smaller, lowering of volatility there. And the trading range for SPRE futures has gone from being about $1.25 or $125 on a given daily basis. And similar to gold futures going from, $12 or $15, which is more than $1,000 worth of movement on a daily basis, to just about 75 cents, or in those gold futures, under $10. Right. So almost cutting by 50% in that daily range. Now, Pete, I posed the idea of, getting dollar plus moves in SPRE futures, coming down to less than $1. Well, instead of just waiting for that dollar again, tightening up those entries and reducing size. So instead of doing maybe 3 futures outside of $1, getting a little bit more aggressive, but doing one, and one. And so if the market does move like it used to on any of these given days, you still have a good average price. But if it isn't, going out past that dollar and you still want to get something on, you've got something on at smaller size. I mean, is this what you and your experience look to? Because we get lowering volatility several times throughout the year. How do you deal with it?
And you're spot on. I mean, the first thing you do, and again, this is an acquired thing you usually use by, you learn by negative reinforcement, i.e. losing money, is you have to be mindful of the size you're trading versus what the market is giving you, not what you expect. Oh, this stuff should be ripping out. Again, we always talk about, whenever we hear the term should be, we stop trading that product, because it should be is the greatest fallacy in the world. The market is perfectly priced at this moment in time. Mm-hmm. So this really speaks to, okay, the market is giving us a different set of expectations. We're going to take advantage of that with a smaller set of tradable opportunities. And that speaks to, because the question always would be, okay, the range is in the 76 cents. Why don't I just trade the 3 lots? Because I can try to make the $210 instead of the $300. And you know what? Part of it is this elasticity, or this need for a greater piece of movement to have an appropriately, not appropriately, but a larger size trade. I think here you've really come across something that I got to tell you, a lot of guys had a very hard time doing it. I'm a 50 lot trader, so I always trade 50 lots. No matter if the market's giving me a 5-tick range or a 100-tick range, I'm going to flip those 50 lots. Never works out. Here, you're actually taking what the market's giving you. But if we do get those outside days, you're going to take advantage of them. Move that 50-50 dial of statistic, coin flip in your favor by trading some of these outliers. And that's where you're going to get. Sure. But at the same time, you're not going to have your full unit size on at that 76 cent move. You're going to have more of it on when statistically you're getting a better edge.
Well, that's exactly right. And I'll always remember my old risk manager, Gene. I was talking to him at the Board of Trade, because when I first started out, a lot of movement in interest rates. And then in my second and third month, volatility just came out of the market, like we're seeing right now, just not a lot of big moves. But when I entered, I was used to like, all right, they're allowing me to do 5 knob spreads when I entered, let's say. And the knob spread was moving 5 ticks on either side of unchanged on a nightly basis. And so when it went from moving 5 ticks on either side of unchanged to moving only 2 or 3, I wasn't getting my 5 units on because I was waiting for 5 ticks up to sell into or 5 ticks down to buy into. And Gene comes to me and he's like, dude, you're not doing anything. And there were nights, Pete, where I showed up and I was looking at screens for 12 hours and I didn't trade a single thing. And he's like, dude, you got to do something. And I'm like, what do I do? What do I do here if I'm used to selling at 5 and buying at -5? And he was like, well, instead of using your 5 units at those 2 values, those 2 outlier moves, what would be, $1.50 or $2 in spree here, just come in to 2 or 3 ticks worth of movement, get one done at 2, one done at 3, and then another at 4 and 5 and 6. And so if it gets out there again, your average price is still close to where you normally get in, but like we've seen, it's day after day of inside movement. You got to get something on those inside days. And I'll always carry that with me. It's not a matter of taking those 5 units, Pete, and just being like, all right, I'm adjusting from high volatility to low volatility and then getting run over and giving, like you always say, picking up nickels in front of the steamroller, but reducing that size and scaling into those positions, or else you're not going to get anything on. The last week and today, you're not getting anything on. Now, here's a market where I think it's gone too far with the low volatility. This 2-year, Pete, has officially become a strict investment play. Its average move now is within 10 ticks, which is just $10 here. The range moving forward for the next week is just about 20 or 30 cents. That being said, this market is down 12% in the last couple of months compared to a 10-year and 30-year yield, which is unchanged in the same time frame. And we're getting close to those historic lows in the 2-year. And I've been talking with people about this. It's frustrating with the roll, but this is an investment piece that I still like to have on going forward. And you just have to deal with that roll and keep this going, because we could see that jump back to normal this month, next month, or September, October. But this is investment. There's no scalping in here, right?
No, and you know what? 2 ticks is 2 basis points. So right now, if the 10s and the 30s were moving, and you could argue that the curve may get some movement, then your 2s become maybe part of a scalp. You can't argue that in terms of the percentage basis, we are down to the lows. This becomes, as you said, for $48 of overnight margin, this becomes that short end anchor. If you believe, and again, number of different scenarios. One being is that, the Fed eventually, with everything, doing quote unquote so well, commodities, again, ripping to the upside again today. We touched $70 at crude earlier. They're going to have to tighten rates. The short end of the curve is where you want to be long yields or short prices. This is that kind of trade. What's nice with this trade is that you're getting the extreme and you are doing it in a very capitally efficient way. This is not, and I agree with you, 9 ticks is like, and we've always talked about this with another product, Eurodollars. 90-day time deposits, a much bigger product at $1 million of notional, but they would get a 2.5 tick range. It's not a daily tradable range. Nobody can buy the low, sell the high in that. And you're really getting into kind of that same piece here. Now, were those Eurodollar trades we used to do trades that were done over months? Absolutely.
Yep.
And this is shaping up to be the same size trade, just with a lot less complexity and a lot lower buying power.
Well, and I'm glad you bring up that Eurodollar piece, because I remember, that's what I was trading at the Board of Trade, and I traded there. I started out when rates were at 0, and thus just the way that Eurodollars are priced, you can take a look on your own, but Eurodollars were priced at pretty much 99.50, which is equivalent to about 0% short-term yields. That being said, 99.50 quickly became, when the Fed started to come out with more hawkish statements and data releases started to lean towards the Fed, pushing the Fed, like Pete is saying, to have to hike these short-term rates. 99.50 quickly became 99, and then out of before you could even catch your breath there, 98 and 97
right.
was the normal environment for those Eurodollars. Similar thing here, we're hugging zero. I know a lot of people frustrated with how low this product has stayed and having to roll it month after month, but like Pete said, very efficient with about $50 to trade this. And at some point, if normalization does kick in, the Fed does hike, this $1.50 or $1.60, the new normal for that is quickly going to become $3, $4, $5 as they lift rates off of zero. I mean, $5 in this trade, Pete, is just a short-term rate of 50 basis points or 0.5%. So a good investment piece, I think, still. That being said, you can't scalp that market. Now, here's where I want to conclude, Pete. I put up 2 different pairs trades in the newsletter for subscribers, exclusively for them, updating every week. Subscribers.thesmallexchange.com for that exclusive piece along with the lower fees. Now, the 2 that I wanted to highlight here, which I think are actually, if you take a look at them and you like them, or you like one or the other, they're both pretty good companions to long stock portfolios. The first being a long US dollar and potentially a short 10-year yield here, US dollars versus yields, been highly correlated in recent trading. US dollars far lower in the last couple of months than US yields here. And what I like is that SFX, Pete, has been kind of highly correlated with volatility. That being said, when stocks sell off, we've seen a bid in US dollar. Now, US yields highly correlated with the stock market. So if I buy dollars and I sell yields here and I have a long stock position, this is actually a pretty nice hedge to that. Now, if stocks continue higher here, then that US dollar position is probably not going to help me out as much. And that US yield position being short, yields will probably move higher with stocks. So that position is not going to help me out. But this is a nice one-to-one small hedge, I think, against stocks. What do you think about that one?
I like that one. And I think the fact that you highlighted it as a hedge against stocks is a good one. We like the dollar longs here. I think it's interesting because previously you've seen the dollar have a much higher correlation to things like equities, even gold, and at some points crude. But where we're seeing it is, and I'm glad you pointed this out, it's almost like its own little VIX. It is definitely acting like that. So this is definitely a hedge, and it's a set aside kind of diversified piece. So I think you're creating definitely a small trade here under $300 and taking advantage. It's a nice addition to a portfolio trade when we don't have huge swinging movements everywhere else.
Yeah, and a pretty decent, as you can see there from the chart, a decent standalone trade as US dollars have become so out of favor relative to the euro and the Chinese renminbi, with even US yields moving higher. So a nice pair, a nice addition to a stock portfolio. And the last piece here, another piece that I think is a good addition to that stock portfolio, we were just talking about 2-year rates. You could look at, short SM75, long 2-year rates. That also is a decent little addition to a long stock portfolio. Basically, what you're doing is you're subbing out that long stock by selling SM75, some of those long stock positions for long 2-year yield positions with stocks at the highs and 2 years at the lows. Both of these markets traditionally have a high positive correlation, but most of your stocks in your portfolio probably close to all-time highs. 2-year yields still at the lows. I kind of like taking some of that stock exposure off the table by selling one of those SM75s and buying 10 S2Ys, and thus that's highly correlated to stocks. So you're kind of subbing out stock exposure for 2-year rate exposure with those rates at the lows and stocks at the highs. Another nice one that could be a good addition to long stocks.
Agreed. I think a very different trade, but a nice one in terms of speaking to the hedge again. And you're definitely playing two interesting extremes. This is going to be a little bit more interesting one in terms of management, just on the SM75 side. If we're a little early to the game, but I love the idea of this pairs trade in terms of the extremes, and it's getting away just from trading ranges when we don't have ranges to trade.
Absolutely, my friend. Thanks so
Very
much
good.
for joining me here on Monday
Well,
to
thank
talk
you for
about,
having me.
yeah, talking about all this different stuff. And, low volatility doesn't mean that we stop trading necessarily, but just find some different stuff to trade. And I think we found a couple good ideas, but let's jump into the platform in the next segment, get those ideas to execution, and maybe a couple other ideas. Some stuff is moving inside day by and large, but we'll find some opportunities. Everybody stick around for Splash in the Futures coming up next with me and Peter Momet. Thanks, everybody.